Are you worried about how the market will affect your retirement? Let's dig into what you can do. Welcome to Retirement Revealed. I'm your host, Keil, and we're here to turn your retirement savings into retirement income. Today, we're talking about how to protect your retirement with all the market volatility. This was prompted by an article I read in Barron's. The title is Market Anxiety is Running High. I'd say that's the case. I'm hearing that from quite a lot of folks. And then the title says How to Secure Your Retirement Portfolio. Not sure if I would use the term secure with anything related to portfolio, but that's the term that they use. I like the term protect. I think that's protection is important with your retirement portfolio, but doesn't guarantee, doesn't totally secure your retirement. I think even that term secure, securing from what? A lot of people are worried about, what if I lose some money today? Well, they might be making choices that with their investments that prevent them from gaining money in the future when it comes to inflation. That's the common way to look at your investments is the more secure you make it today, the less likely that your investments might grow with inflation for when you might need the money in the future. So it's a balance out there, and thankfully it's a balance in the portfolio. In the article that they have here in Barron's, wanted to share that article with you, give you my thoughts as well too. But Barron's brings up 5 different ways. I'm going to start using the word to protect. 5 different ways to protect your retirement with the market volatility, with this market volatility. And of course, it's interesting. Everyone thinks this time is different. It seems like people are asking me, what should we do based on the market? Look at what's going on. Based on the market, what's going on has always been going on. I don't think there's anything new here in terms of the market being up and down. But the first thing to look at, according to Barron's, and I agree with them here, is be realistic about the next decade. The last, let's see here, 2025 back to 2009, last 16 years have been amazing in the stock market. You've got returns that are some of the best returns for that long of a time frame. And being realistic and putting in projections to your retirement that assume that whatever happened in the past is going to keep on happening is something that might cause you some disappointment. And there's a lot of people projecting lower returns. Barron's quotes Morningstar. In January, they took some predictions from investment firms. They forecast a range 3.4% to 6.7% returns for U.S. equities over the next decade, which is certainly less than the 20% that happened in 2023 and 2024. So it's a good reminder that whatever's happened recently, that you can't count on above average returns for a long amount of time. And that gives you an opportunity. If you're somebody that believes that the stock market might not do as well in the future as it has done in the past, now's the time to look at rebalancing. Now's the time to look at, do I have the right mix between stocks and bonds? I don't think it's a time to market time to say, let me take up all my profit off the table, but take a look to see what profit do you have on the table. What do you want to do with it? If you made 20% returns in 23 and 24, that's what the S&P 500 looked like. You've got more than you did a couple of years ago. You might have been happy with how much you had a couple of years ago. Perhaps you want to have a similar amount still invested towards the future, but perhaps take some of the risk off the table. Although it's based on not your feelings or my feelings about what's going on with the stock market. It's based on, when do you need the money? I think that's number one question you should always ask yourself is, when do you need the money? Which goes into the second idea that Barron shares, is they say, you want to get your asset mix right. I think that's always a good idea. Get the stock, bond, cash mix correct. But I think the first thing to look at, again, is, when do you need the money? Short-term money you expect to use in the short run ought to be in short-term type of investments. And the money you're expecting to use in the long run ought to be in long run type of investments. I've got a few clients that I met under unfortunate circumstances, I would say. And the unfortunate circumstances were the end of 2019. the stock market was at an all-time high. There's two people I'm thinking of right now. Stock market's an all-time high. Both of them were planning on retiring within 1 year, and both of them were vast majority towards growth, future, longer-term funds. And they thought, I'm retiring a year from now. I've had a great 2019. Boy, wouldn't it be great if I got just another 10% more, 20% more, whatever it was. And then once I hit retirement, that is when I will bring the risk down. That is when I will diversify. Well, a couple things happened, if you might remember, from spring of 2020. COVID hit. So that means their portfolio took a hit. And what happened for both these individuals, their portfolios dropped about 30%. They freaked out because they thought, I can't afford to have 30% less when I retire down the road here in less than a year. And both of them pulled all their money to cash right away, which means when the market came back up, they didn't get the bounce back. They happened to sell at a low point. I think if they had viewed their investments in the manner of when do I need money in short term, when do I need money in the long term, they might have kept their money that's long-term focused still towards the long term, knowing that I've got some short-term money available. And the mistake they made was that they thought, I will take care of this when I hit retirement. I don't think you should wait until retirement to adjust your portfolio for retirement for a few reasons. And both of these individuals face the exact same two reasons. Reason number one, yes, the market might be up most of the time every year, but if you're retiring in 1 year, do you want to count on what happens most of the time? Or do you want to take the money that you're expecting to use a year and a day from now and set it aside into investments that will be ready for you a year and a day from now, and not having the volatility on just that amount, that stock market amount? You don't want to wait until the day you retire to get your investments ready for retirement. The other thing that happened to both of them is they said, we're going to retire 12 months from now when we're going to retire at the end of the year. And then COVID happened. A lot of firms were laying people off. Both of them got let go in June 2020. So they were forced out of retirement, forced out of their company. They were forced to retire 6 months earlier than they expected. So not only should you be ready for retirement ahead of time, because what if the market goes up and down? You ought to be ready for a retirement ahead of time. Your investments ought to be ready for retirement ahead of time, because things happen. If you look at the averages, people retire on average about 3 years before they plan to retire, which is why my encouragement is to be ready for retirement 3 years ahead of time. So when you say get your asset mix right, have the right level of stocks and bonds, I think first it's the right level of short-term money and then long-term money. And when it comes to long-term money, you can't predict the ups and downs of the stock market. You can't predict the returns of the stock market, but you can control a bit the risk levels you have in the stock market by following Barron's advice. I agree. Get your asset mix right. Have the right level of stocks and bonds in between there. Now, the third suggestion from Barron's is to diversify and go abroad. So yes, diversification is important. Diversification is spreading your money amongst a lot of different areas. And interesting enough, ever since 2009, not only has the US stock market performed, but the international stock market seems to have underperformed. The idea is you have a lot of different areas in case one area doesn't do as well. And it's tough when you have 16 years straight, basically, of the US stock market going up. You think 5 years into it, 10 years into it, 15 years into it, why do I bother with international stocks? You ought to bother with international stocks for that diversification. I'm going to look up right now how international and US stocks are doing. I'm recording this on June 4th. As of right now, markets near the close, the S&P 500 up 2% for the year. Meanwhile, the MSCI EAFA index, right, that's an international index, that's up almost 19% for the year. Of course, you can't invest in the index, but I used the ticker symbol IVV. That's just what I had off the top of my head, and EFA, that's how I found those, if you want to track that as well. You got international up 19% for 2025, the first 5 months roughly for 2025, and the S&P 500 only up 2% for the year. That's the power of diversification. And you can't get that diversification truly in the long run unless you rebalance. I think that's a big part of it. I'm not saying that you want to move from US to international in your stocks. I'm saying you want to be diversified and have US and international stocks in your portfolio. And sometimes for 16 years straight, the US stock market did better, and still having that diversification helped out for times like these when the stock market was dropping in early April, and was the SP 500 was down about 18, 19, almost 20% at that time. I looked at international at that time, and it was doing all right. It was basically even, just about, when the U.S. stock market was down roughly 20% at that time. It's working out to have diversification. Now, the fourth thing that Barron's suggests in their article is cash. Stay in the Goldilocks zone. What do you mean by Goldilocks zone? Well, cash is doing all right now, maybe paying about 4% in 2025, better than it has for since 2009. It started finally turning around in 23 and 24. So it's probably an encouragement for you to hold more cash than normal, because that sounds like great interest. Yet when you have money in cash, it doesn't generally go up as much as the US stock market does. And so having that right mix of, if you're invested towards the long term, have that right mix towards long-term stocks is the way that it has historically made it happen. So what does Barron suggest? They say most advisors recommend that retirees keep at least 1 year's worth of portfolio withdrawals in cash. And they cite another advisor, and it says he generally keeps 3 to 5 years worth of retired clients' living expenses in cash and high quality bonds. So I love that they're looking at this range. You ought to have a range of how much you keep in cash. 1 to 5 years is a commonly suggested number. And of course, if you're looking more towards 3, 4, or 5 years, you don't necessarily have to keep that strictly in cash, like in your checking account, your savings account, in your money market type of funds. You perhaps can feel more confident to take on a little bit of risk in your short-term area, but it's short-term type of investments you're looking at for your short-term, and you want to make sure you've got the right level. And if the market's at a high point, oddly enough, right? I just said the SP 500 is up 2% for the year. The international is up 19% for the year. When the market dropped in early April of 2025, you might have thought, oh my goodness, hope is lost. And yet here we are, early June 2025, the market's back to where it was at the beginning of the year. You take a look, your portfolio might be the highest it's ever been, even higher perhaps than it was in February. You want to go take a look at that. And the best time to ever rebalance, pull risk off the table, is when it's at the high point. Now, we don't know if the high point will keep on going, but we know it is a high point. It's almost like you get a second chance now. If you were, here's a good thing to think about, is how did you feel when the US stock market was dropping 20% in a short amount of time with the Trump trade, the Liberation Day, the tariffs that were happening back then? How did you feel about that? Did you wish you had pulled out of the stock market? Did you wish you had pulled out some profits a couple weeks earlier? If you had that wish, take a look in your investments. Don't just be happy that the market's back up again and stick your head in the sand. Think about, how did you feel in the first part of April, and did you have the right level of risk? Now's the time to make sure that you have the right level of risk. Number 5, I always agree with this idea. Bolster other income and Social Security is what Barron suggests. And I agree that you ought to look at your Social Security. You ought to look at your pension to see, what can we do to increase that income? Is it worthwhile to wait on your Social Security? Is it worthwhile to wait on my pension? That's worth considering. If the stock market is down, if the stock market's up, if you're nervous about the stock market, if you're excited about the stock market, you ought to look at any of those times, how do I get the most out of Social Security? How do I get the most out of pension? And I'd encourage you to also look right now at something that is similar to Social Security and pensions. Now, there's a word annuity that creates a lot of emotions one way or another. And I'm not suggesting anyone should or should not get an annuity. But when the stock market's at a higher point, when the bond rates are at a higher point, and if you're looking at your retirement plan and you're saying, I wish I had more guaranteed income, when you're thinking of the stock market dropping 20% in early April and saying, how am I going to create income in my retirement? You would rather cash in some stock market money at a high point, and you'd rather buy income at a high point. And right now, the stock market's at a higher point. Here we are in early June 2025. Stock market's at a higher point. The incomes that are out there at a higher point. It is a better time to make a decision like that when you're in that situation. Take a look first. Do you need income? Do you want guaranteed income? And if so, consider how you might get that from some sort of annuity. And remember, when it comes to these things, no matter what it is, stocks, bonds, cash, real estate, annuities, the different types of annuities, whatever it is, often the answer is not the one thing. It's how does this fit into the entire part of my portfolio? It's called a portfolio for a reason. It's a collection of a whole lot of different things. You will not find a product or an account that is the one answer, but you might find that there are different things you might want to add into the mix of answers that you have in your portfolio. So there we go. We got market anxiety is running high. I hope that that's not the case for you, but it might be today or might be that in the future. And you want to do what you can to control and protect your money by looking at a variety of different answers. Thank you for listening to the Retirement Revealed podcast. We believe if you know more about your money, you will feel better about your money and you will make better money decisions. Hi, I'm Jeremy Keil. If you'd like to learn how my team can help you get more income, pay less in taxes, and avoid big retirement mistakes, head on over to keilfp.com. That's KEILFP.com.